ways away from substantial further progress, but we're still making progress. That's according to Fed Chair Jerome Powell. Soon after the Fed issued its statement, U.S. stocks fell further from the record highs and bond yields rose. As a result, Powell changed his tone and emphasized that inflation is temporary. Well, it's been temporary for the last 40 years. Powell is now emphasizing that the economy is not where it should be, especially in terms of unemployment, and the Fed still thinks the economy needs stimulation from the central bank. He also said hiring should accelerate through summer and into the fall as COVID-19 recedes further with increased vaccinations. That will allow schools and daycare centers to open, which will enable more parents to work, while supplemental income from the federal aid will also help with ending joblessness. Powell added that the Fed's policymaking committee also began discussing when to reduce its monthly bond purchases. There's no definite date yet, but the purchases, which consist of $120 billion in Treasury and mortgage bonds, are intended to keep longer-term rates low to encourage borrowing. The Fed has made it clear that its first step in slowing its support for the economy will be to pare its bond purchases, and that would begin to raise rates only sometime after that. Its key rate has been pinned since zero since March of 2020, basically the beginning of the pandemic. Powell also emphasized the Fed might be in a hurry to withdraw its economic support by making borrowing more expensive. The economy, he said, still hasn't improved enough to reduce the pace of monthly bond purchases, which the Fed has said it tends to continue until substantial further progress. That's a strikingly different tone from the original statement. This, however, is important for us to know and also to understand. The Fed and the entire government will say whatever they need to say to keep our confidence high. They will interpret the numbers the way they want to make us basically feel better. Another key consideration for the Fed is whether inflation persists long enough to affect the public's behavior. If Americans begin to expect price increases, those expectations can trigger a self-fulfilling cycle as workers demand higher wages, which in turn could lead their employers to keep raising prices to offset their higher labor costs. So make sure to do your analysis and have your own conclusions, consult experts. That's the only way to get an objective view of our economy. And that's the only way you can invest right and allocate your portfolio in a way that makes sense for you. Also, you should look at being diversified. ETFs, stocks, bonds, crypto, businesses. These are all great hedges, and you should have different asset classes in your portfolio. The best right now, in my opinion, with inflation is definitely gold. Throughout history, each time we go through this distress, instability, inflation, gold seems to thrive. That's why you need gold. You need that one asset that will shoot up when everything else is down and it will remain steady. That's where Noble Gold Investments comes in. Even if you don't want to buy, you just have questions or you want to learn about this, call us for a no pressure conversation. You can reach us at 877-646-5347 or go to noblegoldinvestments.com. If you're interested in investing in precious metals and you want to talk to a no hassle representative that has experience in physical metal, give us a call. Phone number is 877-646-5347. Our phone lines are always open and we're happy to answer any of your questions.